Each lender has a standard variable rate for their mortgages, and that's the rate that you end up on once your initial introductory deal has finished. So let's say, for example, you take out a 2-year fixed rate mortgage, it comes to its end and you take no action at all, which is, to be fair, usually a terrible idea. But once that deal comes to its end, you'll default onto that lender's standard rate of interest. And normally what that means is your payments will go up. The only advantage really of being on a lender's standard variable rate is that you're free to make unlimited overpayments. So let's say, for example, you're taking out what you think will be your last ever mortgage, and you've got 1 or 2 years left to run when your product comes to an end. Well, you might at that point in time decide to stay on the standard variable rate because you won't be penalised for making overpayments or making lump sum payments. Now, each lender sets its own standard variable rate completely independently of what's happening to the Bank of England. Although, to be fair, what happens is that if one lender puts their standard rate of interest up, others tend to follow fairly quickly. Most customers, once you've got your initial period is coming to an end, about 6 months before, you should be looking to take out a new deal, because if you lapse on that lender's standard variable rate of interest, the lender wins and no one wants that to happen. Thanks for watching the video. We do rely on user-generated content, so please subscribe if you found the information useful, and send me a question in the comments below or drop me an email and I'll do my best to answer it.